Hi, and welcome to this week's Symax Fintech Weekly Market Report. Before we get into everything, as usual, just go through our disclaimer. So there is the potential risk of loss of capital. It's not suitable for everyone, although we hope trading is suitable for you. And be wary of companies that provide leverage because you can lose substantially more than your initial investment. Everything we include in here is just purely for educational purposes. We're not trying to encourage you to trade or invest. That has to be your decision. And before you make that decision, just carefully consider the risks involved, your financial situation, definitely your level of experience, and also your risk appetite. And you should only risk capital you are prepared, but more importantly, can afford to lose. If you've got any doubts whatsoever, seek independent financial advice before you risk your capital, please. Okay, well, when we look back at last week, there wasn't too much out, but the markets still are reacting. They're still nervous. Powell's speech included mentioning disinflation, but then he went on to continue to emphasise that there was still further to go in taming inflation, especially after you look after the previous week's NFP coming in over 500,000 jobs. Now, because of all that, some are now expecting rates to go above 5%, with some managers also warning that stocks are in a bear trap. They've had a big rally, they look bullish, but they're not. Again, you've got to make your own mind up on that. But the markets do seem less bullish, or they did this week, even after Powell had his speech. And then Michigan consumer sentiment came in higher than expected at 66.4, again demonstrating the strength of the economy. In the UK, where I am, we just managed to avoid a recession again, coming in at 0%. There's still strikes from time to time where workers are fighting for higher wages to obviously compensate for higher inflation. But of course, as inflation comes down, it does make those companies more reluctant to make those big wage claims or to meet them. So there will have to be negotiations there. In the EU, retail sales were down 2.8% year on year, just obviously as consumer demand shrinks further. And German CPI month on month was up at 1%, but year on year it was lower than expected. It came in at 9.2%. Australia increased their rates by 25 basis points to 3.35%. Yes, again, like everyone else, they've got inflation, but they may get to the point where they either slow down or stop. This year you would expect the same thing with most central banks. With China, their CPI came in down 0.8% month on month, and their PPI was down 0.8% year on year. But the CPI year on year was at 2.1%, and wouldn't love, other central banks just love to be able to say that's where their CPI is. But of course, we're a long way off of that yet. And Japan will get their new governor. A change of who's going to probably take over. It's now expected to be Ueda. And that could change things, obviously, with their policies. We'll have to wait and see. That confirmation will be Tuesday. So, with the ground war in Ukraine, it's preparing to escalate. Countries, they're committing to sending more weapons to help Ukraine, which of course irritated Putin last week. And as revenge, he sent the biggest barrage of missiles into Ukraine so far this year, targeting their infrastructure, water and power, etc. And of course, because Europe are putting all these sort of limits on what they're prepared to pay for Russian oil and all that, just capping prices. Russia's also decided to cut production by 500,000 barrels per day from March, and OPEC has decided not to try and replace that. So oil rallied during the week. It went from $72 at the beginning of the week to $80. And it's probably just going to give it a steadier undertone for the moment. And stocks ended the week slightly lower. Gold ranged 1860 to 1900, and the dollar steadied up ahead of next week's inflation data. And there's it just seems that there's room for rates to go a bit higher than was previously expected. And the DXY, the dollar index, it's based against 6 other currencies. It sort of went down into a 100 handle, and then it rallied up to 103. Still well off of the 111 highs that it made sort of towards the end of last year. And Bitcoin closed at near the week's lows as well. So what should we expect this week? So with that inflation data coming out, CPI, we've got PPI, we've also got retail sales, industrial production, and some housing data. So, I expect the data to show an increase possibly in January for demand, consumers spending more, just because the weather was a bit warmer. Again, used auto sales or auto sales in general have increased as well. And that is a massive debt in the US actually, the financing of all those cars. So we have all of that data coming out. And of course, that NFP data that I mentioned before just shows demand is still there, especially for such likes as manufacturing. Moving on to the UK. So yes, we just missed going into recession. We're flatlining around 0 for GDP, so the country is not great, but it's not disaster that everyone expected so far. The inflation data could be lower due to energy prices. Of course, they're starting to peak a little bit now after Friday. And of course, weaker demand, which we could see in the CPI and the retail sales. Strikes are set to continue from various sectors. But watch for the earnings because, again, that's going to give you a bit of an indication into what's going on with inflation through those wage demands. In the EU, we've got GDP and industrial production. Again, warmer weather has really helped keep Europe out of recession. And we also have German CPI. Now, Japan GDP will be released, and as I mentioned on Tuesday, they will name the new governor of the Bank of Japan, which could see them, not instantly, but possibly moving away from negative rates. So, macro outlook. So good data is having a negative impact on markets. The reason for that is it adds expectations that the central banks will need to go higher and for longer with rates. So just again, just be a little bit careful how you react to some of this data when it comes out. Just got to think about what the central banks are going to do rather than, what you would think the market should do. And this week we'll begin to get that insight into recent inflation levels. Now, wages continue to increase as well due to just that shortage of workers. You've got those baby boomers, those over 50s that are just retiring. They've had enough of all that travelling and all that. COVID, working from home and all that has shown them that there's different ways to work, or maybe they've got enough in their funds not to have to work. Tech continue to lay off staff, but that's proven a benefit for other industries because those tech skills will help those other industries to advance at a quicker pace. Where before it was hard for them to attract the people, the workers from the tech industry, and now there's that little bit of a surplus coming through because of the tech companies shedding those staff. It's allowing these other industries to take advantage of that. And that'll be good for those industries. we still have yet to see the impact from China's reopening, I think. Especially the data after Lunar New Year. Yeah, it's going to take probably a month or two for that to feed in properly, not just in China, but probably around the world. And it could possibly boost inflation in the short term. Now, although global inflation continues to slowly fall, it's still more than double, what the central bank's desired target of 2% is in many countries. And of course, the closer it gets, the harder it's going to become to hit that 2%. And an even bigger challenge is going to be, once it's there, is to keep it there. I know I'm going to be repeating myself here, but I need to emphasize that central banks will need to see this rate, this 2% rate that they've set their target rate, for at least 3 to 6 months before they're going to feel that they've won that battle. It's not going to be, oh, it's touched 2%, let's change policy. That's just not going to happen. And, all central banks are really trying to do is force demand levels down to match the supply levels, because, obviously we've had all those massive supply chain issues. Energy inflation has improved. Of course, it's still higher than it was pre-war. And again, with Russia cutting their supply, then we could see just a little bit of an increase there. And of course, 500,000 barrels per day from March is sort of also revenge for countries arming Ukraine, and of course, with the EU putting the cap on oil prices. Now, what a change sort of a year makes, I guess, or maybe a couple of years. Time goes so fast. Semiconductors. They went from being that massive shortage of them, where demand for tech and everything else came in. Now there's a glut of them. They're everywhere. They're in that oversupply mode. Now, of course, part of that is not just the fact that they've ramped up production, but also the fact that there's less demand for goods. Now, mild weather, I would say, has certainly helped keep inflation lower than it could have been. That's been a massive benefit in many countries, not just Europe, but it's certainly helped. And of course, that's prevented Europe probably from entering a recession so far. Again, here, I have to criticise the food industry for profiteering. Of course, we all need to eat. And of course, they know that, so they're taking advantage of it. Global food costs have declined at a monthly basis at the highest rate for the last 3 decades. So, why are we still paying all these such high prices? Okay, they've got to pay a little bit more for energy, a little bit more for workers. But it seems to me that the food giants and the supermarkets are just abusing consumers. Prices are down 18% since the beginning of the war a year ago. These are at cost, not at consumer prices. And yet the consumers are still paying top dollar, top pound, top euro, top everything for their food. And of course, another little trick that they use is shrinkflation. You're paying the same price, but you're getting less goods for that. Recessions. So, okay, we've avoided them at the moment. But it's possible that there will be another potential risk to that, mainly from China opening up. But there's this new sort of phrase that's going around, this new terminology, rolling recession. Now, if you don't know what that is, this is sort of where different sectors and industries within an economy experience downturns at different times. Take the tech, for example. So you're getting sort of negative, positive sectors, and that's sort of leveling out. And that's just actually cushioning the economy, it's sort of rebalancing it. And that's preventing economies from going into a full technical recession. You can look at a housing slump versus factory production, or goods versus services. Look at tech over COVID, it was so strong. And now it's pretty much the weaker sector. And then, of course, you can look at the service sector that's been a major employer, as well as manufacturing. So a soft landing seems more likely for some economies. However, this can still change. Uh, Potential US rate hikes in March and in May, the new Russia ground assault in Ukraine, all of that sort of could still change things. And then just in general, central banks may have to go that little bit further with rates than previously expected. And I will be doing a webinar this Wednesday at 5 o'clock with our friends at Finico Bank, and they host it, where I'll be discussing about the central banks and how far rates may have to go and how they will battle inflation this year. In case you want to join in, I will post the linked on all the social media probably Monday. So Japan will announce Ueda as governor of the Bank of England. That's going to be replacing Kuroda. Perhaps he will lift rates and take them out from negative rates. When you look at their inflation, it has been increasing. It's now around about 4%, and also wage demands are increasing as well. In the UK, the Bank of England are now using the phrase inflation persistence, which could lead to further rate hikes in past March, not just in March. And also the UK just missed a technical recession with a strong jobs market and strong wage demands. Yeah, but, again, just watch out because the core CPI data will be key to sort of what goes on there next. So I hope that's given you a little bit of insight into what's going on and where at the moment. Now we're going to go on to the technical analysis.